All right. It's 8:10 and we have a lot of material to cover, so we're going to go ahead and get started. Welcome. We're so glad to have so many people here in Kansas City today. Actually, this hotel's next to our old building, so it brings back memories for most of us. I'm Robin Marcotte, and the rest of the people who will be presenting with me today will introduce themselves, but we're all part of the Statutory Accounting Principles Working Group staff support. So happy to see everyone here today. Our learning objectives are on the screen. I also want to mention the Wi-Fi is on that prior slide there. Oh, maybe not. That's on the badge. Never mind. So our learning objectives are here on the slide. We're going to discuss new and revised statutory accounting guidance and recent key topics that the working group has been working on, help you understand the exposures and hot topics currently being discussed, and recognize how changes may impact accounting and reporting. Our standard disclaimer is at the bottom of the screen. The presentation is not authoritative. Please refer to the appropriate materials in the AP&P manual. We've got a list of the topics we're going to cover. Again, we're dividing it between 4 speakers, so it may move fairly quickly. We will, if we have time, we'll take questions at the end. So the first issue I'm going to cover is we had 2 referrals from the Valuation Analysis Working Group to the Statutory Accounting Principles Working Group. So VOG is a little bit like FOG for actuaries. They're doing actuarial reviews of life actuarial reports. They pretty much meet in regulator-only sessions, so you may or may not have actually attended one of their meetings. But they sent a referral to SAP that recommended deleting the sentence you see on the screen in Appendix A791, which is on life and health reinsurance agreements, and it was on the Q&A for paragraph 2C. And this paragraph, the whole paragraph was adopted in 2019 and was effective in 2021, but it had this sentence at the beginning. The whole paragraph is about group term YRT, but it had this aside sentence trying to contrast individual life with group term life YRT. And essentially what VOG and the referral said was the sentence was unneeded, and in their actuarial reviews, they found some companies were trying to use this sentence as a safe harbor for their group term YRT contracts on the premium charged. So, the sentence was saying, unlike individual life, group does not do this. And they were saying, this sentence means we can use this premium for our rate. And VOG was like, no, that's not what that says. So we exposed it multiple times. It got caught up in the discussion with another topic on my next slide. Essentially, the recommendation from VOG was to delete it. It was an unnecessary sentence and it was being misused. Ultimately, it was deleted, but it was on our agenda for 2 years. So this was adopted at the summer meeting to delete one part of the QA. This is the bigger topic for us. Again, we've another referral from the Valuation Analysis Working Group on reinsurance risk transfer and reserve credit. So the referral from VOG was about combination reinsurance agreements. So there was YRT reinsurance, which is yearly renewable term. Yearly renewable term is only supposed to provide a very small reinsurance credit, 1/2 of the mortality risk. The actuaries call it 1/2 CX. But because of that, YRT doesn't have to comply with all of Model 791's requirements for risk transfer. So what companies were doing is they were taking YRT and combining it with coinsurance. That reinsurance form's been done for years, but usually it was done where the mortality risk was ceded externally, and then the coinsurance risk was just ceded to affiliates to try to share some of the profits. But the contracts that VOG was seeing were different. They had a shared experience refund across the whole contract. So losses on this side affect the experience refund on this side. And so the experience refund bound the two types of coverages together. So what VOG saw was that some of these contracts were being evaluated separately. They called it bifurcated risk transfer analysis. So they looked at the YRT side and said, it's good. They looked at the coinsurance side and they said, it's good. But they didn't really evaluate the cash flows of the shared experience refund between the two. And when those were evaluated in their entirety, some of the contracts didn't pass risk transfer. And so when VOG saw this, they challenged some of the companies about the risk transfer they saw in their actuarial reports, and the companies said, I'm not changing, we think we're fine. So it resulted in a referral to statutory accounting. Really, there's nothing in the statutory accounting that says you can evaluate one side of the contract and not look at the entire contract. You have to look at the entirety of the contract. So that's what was ultimately adopted by statutory accounting, was adding basically part of a paragraph in SAP 61 on the life reinsurance stuff that says interdependent contracts must be evaluated in their entirety. They cannot require payment from other than the policy income, because what they were seeing on the contracts was the YRT side was charging an excess premium, and that excess premium supported losses on the coinsurance side. And because the contracts, you couldn't cancel one side of the contract without the other, that's how they were mitigating the losses on the other side of the contract. And they can't contain any other features prohibited in Appendix A791, which is always applied. Doesn't sound too hard. Look at the entirety of the contract when you're evaluating risk transfer, right? That's been under discussion since March of 2024 and was adopted this year. And it was adopted at SAP and at the APP task force at the summer meeting. SAP adopted it unanimously. APP was a 37-2 vote. E-committee is still pending because the ACLI has really pushed on this topic, life industry representatives. So the main topic of discussion at this point isn't the guidance that was adopted, it was what contracts is this going to affect. So the effective date language that was adopted is on the screen, basically saying this applies to, it's effective immediately for any new contracts, and it's effective December 31st, 2026 for other existing contracts. The SAP working group wanted to give industry time to look at the contracts, talk to their regulators, and figure out what else they needed to do. The ACLI has continued to ask for, they say they're not asking for grandfathering, but they're recommending it only apply to existing contracts that were in effect as of January 1st, 2024. That was rejected by SAP and the APP task force, but financial condition E-committee discussion is still pending. So adopted, but not fully adopted up through the committee process. That was a year and a half worth of work, 3 slides. Not done, still pending. Stay tuned for news. Jake is next. Thank you.
Hi, everybody. My name is Jake Stoltz. I've been here for almost 9 years. I support the SAP working group and the Reinsurance Task Force Mutual Recognition of Jurisdictions working group. So Robin talked about some important reinsurance stuff we got going on here. I have some other important reinsurance stuff here to talk about, probably a little less than, or at least less contentious than what she's got going on. But it's important to talk about when we get these opportunities. So this was agenda item 2024-07, and this is for MODCO and funds withheld reporting. The agenda item was, it'd been exposed back in 2024, and then we had, we exposed it once earlier this year and then adopted it final in May 29th. So this project originally came from discussions involving IMR, which is kind of an odd place for it to come from. But during the IMR discussions, it was noted there's really no clarity on what the assets are that support these funds withheld and ModCo arrangements. And so there were discussions, we'd held discussions internally prior to that on what we could do, what remedy we could to identify these assets, but we weren't ever really able to get anything moving forward with some of those earlier discussions. But when it came through with the IMR discussions, we were able to get a little bit of momentum and actually do something here. So that's sort of how this thing got started, through an odd place, but you know, we got the project going, so either way it was a good thing. And so just to clarify a bit for anybody who's not as familiar with reinsurance, funds withheld assets are assets that would normally be paid over to a reinsurer but are withheld by the ceding entity to permit statutory credit for non-admitted reinsurance, to reduce potential credit risk, or to retain control over the investments. So under certain conditions, the reinsurer may withhold funds from the ceding entity. And then ModCo assets are essentially a subset, a specific subset of funds withheld assets that follow slightly different rules, but are treated essentially the same within statutory accounting and then for our reporting. And so prior to this agenda item, within the financial statements, if you went to any investment statement, there just wasn't any clarity on which assets. They're just kind of commingled with everything else. There's no clarity on that. And it's problematic because we're getting a lot of questions on what are these assets that are supporting these arrangements. We've been getting these questions for a while, but luckily we got momentum. We're finally able to spend some time and get something on here. So agenda item 2024-07, it didn't propose any changes to statutory accounting. And instead what it did was it added a new Schedule S Part 8 to the life and fraternal annual statement blank. And this would further disclose the assets subject to these funds withheld arrangements. So we originally kind of swung for the fences. I wanted this on all the reporting blanks. It was going to be a part on Schedule F. It was going to be on title and health too. We kind of understood going in that we were probably going to lose that battle, but the real important, the real dollars are on the life side. So take any wins you can get. We got it adopted, so it was a good thing. So anyway, so we got that there. So the schedule, we tried a few different formats when we first started out, but in the end, what we did was we followed closely with the AVR schedule, and this was with work with the Blanks team here at the NAIC. We were able to put together what I thought was a really good schedule. It follows the AVR formatting, and then one thing that's really important with this, originally all it was going to be, looks like AVR, pretty simple reporting, breakout categories. It was going to be all assets, just any assets that are subject to a funds withheld arrangement. As the project evolved, one change that came up was that originally we just wanted reporting. Later it became we want it to flow cleanly into the RBC schedules. So with the AVR format, it does work well with flowing into the RBC schedules. The issue we ran into was that RBC only includes items that share investment risk, while there's other ModCo assets that don't necessarily do that. And so we had a disconnect there. And so in the end, we had because of this disconnect, we kind of at the end on the fly made some minor revisions to make sure that these worked out. So we changed the scope of this a little bit. So it went down to only assets that share investment risk. So as I noted, this is adopted back in May, and it'll be required reporting for a year in 2025. It was kind of the give to get us, the most important thing is we wanted this reporting as soon as possible. So we really were pushing hard to get it. Earlier this year, we spent a lot of time really to get this thing so it was adopted for 2025. And so, as I mentioned, during those final discussions, there's a slight modification to the overall scope of what was reported on Schedule S Part 8. So originally, we were going to capture any assets that are subject to a funds withheld or ModCo arrangement. But at the end, the scope was changed slightly to only require reporting of assets that are subject to arrangements where the investment risk is passed. So because of this change in scope, we're going to, from the SAP working group, we're going to issue a memo at some point here this fall, probably start working on that here when we get back after this training session's done. And basically it's going to be there to clarify that The adoption did not intend in any way to override any guidance in the existing Life RBC instructions. This wasn't to change anything with Life RBC. The intent was to make our reporting cleanly flow into the existing RBC instructions. And the intent of this final adoption, this new reporting schedule only include items that pass investment risk, and it should match up fairly cleanly with the existing RBC reporting. Again, it was not intended to override what was in RBC. We wanted to make it line up with RBC, and so that was kind of what came out of it. But in the end, we did get it adopted. We will have information for next year when the financials are in, so this is a good thing. Process wasn't perfect, like always, like we hope, but an adoption's adoption, so you got to be happy with that. Next up, we had a ModCo, funds withheld, restricted asset clarification. So this is another item we got adopted earlier this year. It was originally exposed back in 2024. It's going to be effective for this year, so it will be part of the reporting for next year. So another clarifying item for that. And so the initial focus of this item was to clarify how ModCo and funds withheld is reported as restricted asset. We were just getting a lot of conflicting answers when we'd ask these questions or when questions were asked to us on how because these, they're tied to a reinsurance arrangement, so how are they being reported as restricted asset? And so it was noted that there was inconsistency across companies on whether they were classified as restricted, and if they were classified, where they were being reported. So there was no consistency in there, and it was good timing because we'd done that larger ModCo item to get both these things at once. So, it worked out really well, but that was the point of it. From the restricted asset standpoint, we just didn't have any clarity. And so, as we noted on the slide here, the revisions capture these assets as restricted on the reporting categories, and it does not result in additional RBC charges. So it doesn't make any sense to give an off-balance sheet charge that would have to be eliminated if proper investment transfer had occurred per the RBC instructions. So in addition to the funds withheld and ModCo change, the restricted asset templates have been they have quite a few revisions in there, and that's in note 5L. With quite a few different, clarifying quite a bit of the reporting changes around restricted assets. And so another key item from these revisions is that the restricted asset reconciliation between the note and the general interrogatories and the reasons why these items are not being reported on the GI. So the general interrogatories, if there's a variation between two, now it has to be clarified in the reporting statements. And we've heard that sometimes we've heard valid reasons on these things, but we wanted at least, if there's a difference between the two, we wanted to make sure there was clarity on what was causing those things. And then another change will be a change on the disclosure of whether ModCo assets have been used for another purpose of the ceding insurer. It's not permitted to take RBC credit for these ModCo assets. So for in this example, if the asset has been pledged to, say, the FHLB, then the asset risk hasn't been transferred, and RBC credit shouldn't be taken. And so in the end, on this project, we had some minor revisions to SAP 1 to clarify these things, a larger change in note 5L in the reporting schedule, and then finally we had we sent a referral over to the Life RBC, and they're going to be working on a project to further clarify the RBC credit guidance around this item. So that is the end of my time.
Good morning. My name is Julie Gann, for those who don't know me. I've been here about 24 years. I will tell you, 24 years ago, I did not need my reading glasses. So it's a little awkward for me, so I might put them on to check my notes. Let's move on. Oh, you already read the slides. Thank you. I'm going to talk two topics today. The first is the IMR, which is the acronym for the Interest Maintenance Reserve. Quick show of hands, who has been following and knows intimately all the discussions of the IMR? Only a handful. Okay, all right, well, good. We'll cover that first. Secondly, I'll talk a little bit about private securities, which is a new disclosure that we have coming. So at the summer national meeting, the key thing that happened is that we adopted an extension to INT 2301, which relates to IMR. And what this interpretation did in 2023 was it allows net negative disallowed IMR to be an admitted asset. Before, if it was a net negative, it had to be non-admitted. So as I mentioned, interest maintenance reserve, high-level overview, it comes about when a reporting entity sells a fixed income instrument before its maturity date for a gain or loss. If that gain or loss is deemed to be interest-related, not credit-related, if it's credit-related, that goes to the AVR, then it's either recognized as a liability if it's a gain, and then that is amortized and deferred over time. If it's a loss, it's recognized as an asset. So again, we're talking about something that has money out the door. So you have recognized a loss, but we recognize that as an asset, not admitted. But with 2023, with the change of interest rates, discussions with ACLI, there was a compromise provision to allow it to be admitted up to 10% of adjusted capital and surplus, only for the companies that weren't in an action level. So with that adoption in 2023, they formed this IMR ad hoc group to study IMR and come up with what we refer to as the long-term solution. So that group meets about every other Monday. It's a lot of work. I'll tell you right now, it's a lot of work getting ready and having all those discussions. And they've had a lot of great conversations, made a lot of tentative decisions that are going to be reflected in issue paper, and we have a lot more work to do. So one of the reasons for this extension was to give that IMR ad hoc group more time to come up with those final conclusions with regards to net admitted negative IMR. So with the adoption that happened at the summer national meeting, along with the extension, there were a few other revisions that were reflected in the INT. First, the way the INT provision works is it allows this 10% of adjusted capital and surplus. And we clarified that that adjusted capital and surplus is based on the prior period financials, which is consistent with all of the other statutory guidance that we have where we do adjustments, because if you use current year if you use the current time frame, it comes very circular. And so, but when we looked at the information that companies were completing, companies were pulling these adjustments from all over the place. Some were the year-end financials, some were prior periods, some were the prior year. And so we clarified that all of those adjustments, and when I say adjustments, it's like goodwill, admitted DTAs, I call them the soft assets. So you have to adjust capital and surplus to remove those soft assets and then calculate the 10% limit. So we clarified that that's prior period. So for year end, you use third quarter. We also included an additional cap of 10% of current period unadjusted capital and surplus. And the reason for that is when we were looking at the data, we saw a couple of instances, not a lot, there were just a couple, where someone's capital and surplus had tanked between third quarter and year end, or the net negative IMR had soared between third quarter and year end, and they were over 10% of current period adjusted surplus. So regardless, the 10% limit there, generally of adjusted capital and surplus for prior period, but additional cap of current period. We also incorporated additional revisions to the disclosures. So the INT always had disclosure requirements, but when we were looking at the year-end financials last year, we found that a vast majority, I shouldn't say vast majority, I'm pretty sure it was a majority, but a vast number of companies did not complete the data capture disclosures. So that makes it really hard for NAIC staff to do any sort of aggregation and assessment, because that means we have to go to each individual financial statement and pull that data. I don't know if that was done on purpose, but this year we clarified that you must complete the data captured templates in order to admit that. So if you don't complete those data captured templates, just go ahead and not admit that net negative IMR. We also incorporated additional revisions to clarify some of the disclosure elements. There's some roll forwards in there with derivatives, and we spelled out basically how to complete a roll forward, because there were some situations where the amortization was taking it more net negative, and that's not how amortization works. So we clarified that to make sure the guidance would be clear going forward. There were also a few other comical elements. We saw instances where companies had positive IMR, but they were reporting a net negative IMR balance. us, these things don't make sense. So we clarified that INT for application going forward. There was also a new requirement to include the net negative IMR in the PBR calculation or asset adequacy testing, cash flow testing. That was also always an element, but now it's explicitly stated in the INT, and there's also a reconciliation requirement. Working with the LATIF staff support, when they looked at some of those reconciliations, they saw that companies perhaps were going the wrong way with how they were including net negative IMR. So those reconciliation templates have been publicly posted on the SAP Working Group website, and those should be used to make sure that net negative IMR has been properly included. All right, and let me just say, I love questions, so if anyone has questions throughout, don't hesitate to interrupt, and for those online, we're also monitoring the chat, so feel free to throw them in there as well. All right, so with regards to net negative IMR, I mentioned the ad hoc group that is looking on a long-term solution. So the ultimate goal that we have is to incorporate the IMR guidance into SAP 7. So if you're familiar with SAP 7 now, you know it's about 4 paragraphs long, and it says, go to the annual statement instructions. Okay, so under the statutory hierarchy, SAPs are highest in the hierarchy, and they overrule what's in the annual statement instructions. Annual statement instructions are actually third in the hierarchy, second below the INTs after that. So we need to get the accounting guidance into the statutory accounting guidance to eliminate any of these statutory hierarchy concerns on what takes precedence. So that's the ultimate goal. And we're working through all sorts of elements. Where we've come so far is that we've released, and I'm going to use the word adopted, but I'm going to use it very loosely, a definition of IMR. So as the ad hoc group comes to a somewhat consensus, it goes to the full working group. They then discuss it, expose it, consider it. But all of this is going to come into an issue paper and then a revised SAP. So although there's been a definition adoption of IMR, that's just phase 2. It still has to go in the issue paper in the SAP, so there's going to be another bite of the apple if you don't like how that definition ended up. But ultimately, IMR and AVR, technically, don't meet the definition of an asset or liability in any accounting regime. US GAAP, IFRS, statutory accounting, they don't meet the definition. It is a specific statutory accounting concept. So although we recognize it as a liability and we recognize it as an asset, technically those things, if you were looking at a non-insurer, and it gives part of the discussion with regards to seeding and offshore reinsurers, they're not recognizing IMR. It's not an asset or liability on their books. So we did come up with the definition. It is a valuation adjustment. It's a statutory accounting adjustment used to offset the changes from basically holding items at amortized cost, selling them, and then acquiring another fixed income instrument to match the long-term policyholder liabilities that still exist. Another element that we've made significant progress on, I would say we're on the verge of completing it, is the proof of reinvestment. A fundamental concept of IMR is that if you've sold a fixed income instrument before its maturity date, you use the proceeds to buy another fixed income instrument. So if you're using the proceeds to buy an equity instrument, you shouldn't be deferring that gain and loss. Or if you've used the proceeds as an actual cash outlay to pay claims or excess withdrawals, you should not be deferring that interest-related gain or loss. So there's this new template that's been developed. It'll probably be incorporated as a disclosure to SAP 7, where companies actually have to calculate and show whether their fixed income instruments that they've acquired exceeds basically the fixed income instruments that they've sold. As another little component to this, you should be hopefully acquiring with the proceeds a fixed income instrument that has a higher yield than what you sold. Otherwise, the question comes in of why did you sell that investment if you weren't going to get a higher yield? So this proof of reinvestment template also has, it's basically 2 tests. Have you reinvested into other fixed income instruments based on our calculation of information from the cash flows or from the cash flow statement and your sales and all this stuff? And then do you have a higher yield? If those 2 tests are not met, then the concept that's being considered right now is that you would not be able to admit more net negative IMR. So if you were net negative and you were going more net negative, you would have to do this test to allow for that to occur. And then lastly, which is another concept that's been adopted, again, loosely used term, has to do with hypothetical IMR. Hypothetical IMR is an existing concept in the annual statement instructions today. It has to do with ceded reinsurance. So for reinsurance transactions, if you had sold a fixed income instrument and recognized something to IMR, and then you cede the assets related to that, you would remove that IMR element. And then the current assets that you sold to transfer, you wouldn't put those to IMR. Technically, under current guidance, you would put them in IMR and then you would take them right back out. But then there's this concept of hypothetical IMR, which is what you would expect to sell related to that reinsurance transaction that would go to IMR. You would take it out of IMR now. So after much discussion, this has been analyzed beyond what possibly could occur. It came to an agreement that we understand the historical reason for why this concept exists. We learned that no one is following this guidelines. If they are, they're not doing it consistently. So the concept of hypothetical IMR is planned to be removed from the annual statement instructions and not continue going forward. And I don't think anyone's overly upset about that. All right, so that's going to conclude my IMR discussions. I guess my highlight is we have a lot of work to do. We're hoping to be done by next year, because again, the extension of the INT is only through 12/31/2026. It automatically nullifies 1/1/2027. I don't want to predict whether the SAP working group would go for another extension, but I want to say no one really wants that. So that's our goal. We got to work fast. All right, moving on. This is a new exposure that happened at the summer national meeting. It relates to private securities, private credit. It is a massive item of discussion. This is a new agenda item that I feel very comfortable saying has been supported by the regulators. I've been asked to put something together for some time now, and it's just been really hard to define the components, but we've got there. We have this item. Ultimately, it is going to ask reporting entities to identify in their financial statements for every single investment, whether it's a public investment or if it's a private security, what private category it falls into. And this would basically impact all investment schedules where securities could be subject to SEC registration, which is basically bond stocks and other invested assets, recognizing that not all investments that are on all of those schedules are subject to SEC registration, but there is an NA category for those as well. To go over these in just high-level overview, 3 broad categories of private securities. First is Rule 144A. This actually doesn't relate to the issuer. In fact, the issuer is not allowed to be involved. This is when one reporting entity sells an unregistered security to another reporting entity. It's basically the resale of securities. Under our financial statements right now, we actually have a total of Rule 144A securities. It doesn't identify them by security. It just, I think it's on a D1A, there's a category for private securities, which is an aggregate total, and at the bottom it says how much of that is Rule 144A. The next is Regulation D. Regulation D actually has 2 categories, 504 and 506. From our preliminary conversation, no one really cares if it's 504 or 506. They just care that it's Regulation D. This one is an issuer-specific item. It does require a filing with the SEC. So these have Form D filings. Those are publicly available on the EDGAR database. It's not a full registration, but it is a form of filing. And then the last one, which I refer to as the general exemption, is basically an issuer can sell an unregistered security to specific types of investors, sophisticated, institutional. I'm not exactly sure the terminology they use for that one, but only for those particular types of investors, as long as it's not a public offering. This is also specific that if I sell a security as the issuer to someone, that someone also can't sell it to somebody else unless they also meet the criteria for being, I believe it's a sophisticated investor. So those are the general requirements. For general exemption, there is no filing with the SEC. And the definition of whether something's a public offering is really subject to discussion. There's some court law that basically supports that, but there's no specific definition. So what does the agenda item do? As I already mentioned, every single security on certain investment schedules would be a new electronic column. They would all be identified with one of those codes, with an NA for those that are not applicable to SEC registration. So that's the main change. The second one would then be an aggregate disclosure that basically pulls all that information together by investment schedule, by security type, and then buckets it with other items that regulators have identified as items of importance with regards to certain private securities. So for example, if it's a Reg D and it's on Schedule D, we'll just make that up, there would be a total column, the total book adjusted carrying value of those, the total fair value of those, the total level 3 fair values of those, the amount of paid in kind interest that relates to those, the amount of aggregate deferred interest, and then the amount of book adjusted carrying value of those that have support by private letter ratings. These are key characteristics of these private securities that the regulators have said that's what they focus on, so we were going to try to make it easy for them to have that in a one-stop aggregate disclosure. This item has a shortened comment period deadline. It's actually coming up September 19th. The reason for that is because this needs a blanks proposal to go along with it. But we didn't want to do the blanks proposal concurrently if there was going to be discussions of what was being asked for capture. So we have a shortened comment period deadline to make sure we haven't completely missed the mark with what we're asking. We have a call scheduled on October 6th to consider those comments. Fully expect some comments to come in. I've gotten some preliminary feedback from interested parties. For example, I've heard comments from IPs, do we really need 2 categories for Reg D and general exemption? Could they just be bucketed together? My initial response to that is I'm pretty sure the regulators wanted those separated, but definitely up for discussion. So if you have feedback on that, especially if you're a regulator and you have an opinion, by all means, let me know. So we'll have those comments. It'll probably be re-exposed, and then we will sponsor the blanks proposal. The goal is to have this in place for year-end 2026, which means everything has to be adopted through blanks and SAP working group no later than May of next year. All right, whirlwind. We got about 12 minutes left, and we have one more speaker, which times it out right. So I will turn it over to Will.
All right. Good morning, everyone. I'll be your last speaker. My name is Will Oden. I'm staff support for SAPWIG. I'm a fairly new face by NEIC standards. I've been here for 3 years, which means I'm a veritable baby. The agenda item I'll be speaking on is regarding investment subsidiaries. So agenda item 2024-21 was initially exposed at the 2024 Fall National Meeting after questions were received on the classification of investments as investment subsidiaries in Schedule D61 and in the Life RBC formula. So as a bit of background, an investment subsidiary is an entity that only holds assets for the benefit of the reporting entity. So this concept was originally introduced in SAP number 46, and at that point required equity method valuation adjusted for statutory principles. The investment subsidiary concept was then eliminated in 2005 with the adoption of SAP number 88 and was not reincorporated when SAP number 88 was replaced with SAP number 97 in 2007. So this has not been a statutory concept for a very long time, in all honesty. However, while this was eliminated from SAP and was never reincorporated, the references to investment subsidiaries have remained in the annual statement instructions ever since 2005. So the initial exposure of this agenda item was to primarily spur discussion and invite comments from interested parties on the reasons for forming investment subsidiaries rather than directly holding the underlying investments. Because as I said, remember, these are SCAs formed specifically to hold investments for the benefit of the reporting entity. The other information we were looking for was to find out what types of assets were being held in these structures as well. We'll kind of get into why that's not readily apparent on the annual statements as well. That's actually being one of the issues. So the most recent exposure of this agenda item at the 2025 Summer National Meeting recommends removing the investment subsidiary concept from Schedule D61 in the annual statement instructions. So as I've said multiple times before, it does not exist in statutory accounting, the manual, so there's no changes to that. It's all on the annual statement side and the RBC instructions. So this recommendation was drafted per discussions with regulators, is also intended to bring the instructions into alignment with the existing guidance in SAP number 97. All right, so the reason why this matters is twofold. The first reason, and representing the main concern, is that the current reporting of investment subsidiaries lacks any transparency for regulators and allows companies to potentially receive beneficial RBC treatment simply by placing the investment in an investment subsidiary rather than directly holding the investment. So placing the investment in an investment subsidiary effectively allows the company to obtain favorable look-through RBC treatment by circumventing specific asset and SAP treatment of that investment. So there isn't an explicit asset detail of what's held in these investment subsidiaries. So there's no mechanisms to ensure compliance with SAP requirements, state investment limitations, or the RBC calculation. So, for example, if an investment held a private letter rating and was placed in an investment subsidiary, there would be no way to verify that the security had complied with the SVO or PLR reporting requirements. Same could be true of debt securities and whether they reflect bonds under principal-based bond definition or if they should be captured as non-bond debt securities. Once they go in the investment subsidiary, they just kind of disappear from view. They're an investment subsidiary. What's within it is not readily apparent unless you start digging into it and requesting more information. So one of the other issues with this is that Schedule D61's instructions require reporting entities to measure investment subsidiaries using imputed statutory value, which is an undefined term, hasn't been defined since 2005 when this was all removed. And in addition to being undefined, it conflicts with SAP number 97, which requires measurement based on audited US GAAP. So reporting of the imputed SAP valuation also, for RBC also relies solely on company-provided records, meaning the calculation cannot be verified using information contained in Schedule D61. So again, gist of that one, once it goes into investment subsidiary, it just kind of disappears unless you start digging into it. So second reason why this issue is important is that the reported value of investments held in investment subsidiaries has been increasing. And there is a concern that if the investment subsidiary concept remains as currently shown, more and more investments are going to be captured in these self-formed SCA structures. Because again, there is an upward trajectory showing right now. As part of this project, regulators did request an explanation of the drivers behind this growth, as well as a comprehensive listing of the types of investments held in investment subsidiaries. So there have been some investments which have been specifically identified in the comment letters received, but we haven't really gotten any sort of comprehensive overview of what's in there even at this point. And as you recall, this was exposed in fall of 2024. One of the larger asset class, one of the other questions I was asked is specific reasons for why these investments need to be held in investment subsidiaries as opposed to directly held. In some cases, for those assets which have been identified, we've gotten explanations for that, but again, lack of a larger listing, there's not really any good any explanation we've received for why they have to be an investment subsidiary. So one of the larger asset classes that was identified by industry as being held in investment subsidiaries are statutory trusts. So these are going to be discussed in more detail in a few minutes, but basically these structures serve as investment vehicles for insurers to invest in residential mortgage loans. All right. So it is important to point out that the revisions being proposed by this agenda item would not prohibit insurers from owning investment subsidiaries, as these structures are authorized under Model 280. However, Model 280 does not provide accounting or reporting guidance. That responsibility primarily lies with the SAPs and the annual statement instructions. So SEAs previously reported as investments would instead be subject to SAP number 97, paragraphs 8BII or 8BIII, that's a mouthful, depending on whether they meet the activity test. So the main point I want to highlight here is that the concern is not the holding or usage of investment subsidiaries, but rather that the legacy instructions allow for investment subsidiaries to be used as a loophole for providing explicit asset detail and potentially for RBC arbitrage. As the balance of investment subsidiaries have grown over the last several years, and with it, but the potential for company-calculated RBC, we do anticipate that this will be an issue that is going to be pushed back on, but we believe that the removal of investment subsidiaries from the annual statement instructions is a good step to closing this avenue for RBC arbitrage, and it does also align the instructions with existing SAP guidance. So now the next thing I'm going to be talking about is also related to the investment subsidiary project, but is a separate agenda item. So this is in regards to statutory trusts. So agenda item 2025-13 was developed at the working group's direction in response to the comments we received on investment subsidiaries project. So it was first exposed May of 2025. So unless you're following pretty closely, you probably haven't heard of this issue yet because it's very, very recent. The latest version was also exposed at the 2025 Summer National Meeting. So it proposes revisions to SAP number 37, which would establish accounting guidance to allow residential mortgage loans to be held within qualifying statutory trusts to then be reported individually on Schedule B. All right, I'm going to try and move through this pretty quickly so we have time for questions. So, all right. So, as I mentioned before, the statutory trust was one of the list of reasons why investment subsidiaries was said to have increased over the years. And the reason for that is because the statutory trusts are used to invest in residential mortgage loans. Now, the reason for that is that there is a licensing requirement by each state that insurers would have to comply with if they directly held residential mortgage loans. So potentially, every single state that they have a residential mortgage loan in, they need that licensing requirement and would have to maintain it. So the reason why statutory trusts are useful is what insurers can do is they are a beneficial owner within the statutory trust, and then they can designate a federal or state savings bank which are exempt from the state licensing requirement as the trustee. And since they are the trustee, they are effectively the on-paper holder of those residential mortgage loans. And as a result, the statutory trust is able to use their exemption and not have to get licenses for every single state. So it significantly reduces the administrative burden on insurers. So there is a very strong good reason and efficiency for placing these within statutory trusts. So as a result of that, that's one of the reasons the working group directed us to start an agenda item for potential inclusion in SAP number 37. All right, so one of the key concepts proposed by these revisions is that of a qualifying statutory trust. QST. So for a statutory trust to be considered qualifying, there are 6 criteria which must be met and maintained. First, trust must be U.S. domiciled. Second, the insurer must own 100% of the beneficial interest in the trust. The trust can only hold certain assets, cash equivalents, real estate acquired through foreclosure, and residential mortgage loans. It can only engage in mortgage-related activities. All mortgage cash flows have to pass through directly to the insurer, and they have to maintain proper documentation and records. I mean, that one should be a given, but it is the criteria. So, important thing to note here, I've gone through those criteria very quickly. Statutory trusts have to meet the criteria and maintain them. You don't just do it one and done. It's got to be kept throughout the entire life of the trust. So for example, if a trust were to acquire something that is not one of the allowable assets, it would fall out as a qualifying statutory trust. All right. I think I'm on the right slide. Okay. Now, assuming it is a QST, the balances and activities within it would be accounted for and reported as if they were directly held by the insurer. So I probably mentioned it very quickly in passing. These mortgage loans would be shown on Schedule B, individually reported. We did toy with the idea of doing aggregate reporting because one of the other things is that residential mortgage loans are pretty small dollar value, so you potentially have a large volume of these. It was a little bit like a triangle peg and a circle hole. It just didn't fit Schedule B that well, so we're opting to go for the individual reporting of residential mortgage loans. And if we end up with a 100-page long Schedule B, we may revisit that. So that's where it is at the moment for that, but that was the rationale for the individual reporting. Aggregate reporting just was a little bit clunky, as it were. So as I mentioned, balances and activities within a QST would be reported as if directly held by the insurer. And it's important to note that QSTs do typically have some operational activities. It would not be unusual to see liabilities and expenses within the trust account, but they're not true operating entities, so the liabilities and expenses that would show up in these trusts should be relatively minimal. All right, I'm running really out of time here, so I'm just going to very quickly go through this. This is the admittance criteria. The gist of it is basically if the trust itself is, say, pledging the assets of the trust as collateral to gain funding for the trust, that's an issue for admittance. If the insurer, say for FHLB borrowings, is pledging the residential mortgage loans they have in trust, so basically if it's from the front end where the trust itself is pledging as collateral, it's not admitted. If it's on the back end where the insurer is pledging as collateral, it's not an issue. The main reason for that is we're trying to address the concern of a senior claim on the assets of the trust being created by the trust administrator. That's the main issue. This will be an important consideration for insurers looking at leveraged statutory trusts versus all cash statutory trusts. All right, final thing here, and then I should be done, is there are new disclosures proposed. Main disclosure that I want to point out is that there will be a listing summary of all assets and liabilities held in QSTs, since they'll be reported as if directly held by the insurer. This is to make sure it's easy to tell what's actually in a statutory trust. All right, recap and questions. I know we are ever so slightly over time, but we could take a couple if we needed to.
I think if anybody has any questions, feel free to find us
We'll be
afterwards.
outside
We're
for a
out of
bit.
time. And if we had any online, we will try to make note of those and get back to you.
Yep.
Thank you all.
Thank you much.